are going to analyze the analysis of Canadian inflation trends and monetary policy. This analysis was done by Ayomikun Oranuga, Ajit Singh, Jagrup Singh, and Tianpeng.
According to Rosa Baza, the main article titled Economists predict inflation deeper below 2% in September. Canada inflation rate fell to ground 1.8% in September, mostly as because of the global gas price. The development raiser expectation for the Bank of Canada to continue cutting interest rate. Economics including through from BMO and TD Bank forecast that inflation will hover between 1.8% to 1.9% just before the bank next interest rate decision. The main conclusion in that as inflation declines, the Bank of Canada can now reduce interest rate in an effort to help their economic and control. Look at the picture for the Bank of Canada for the main message. The central message is that declining inflation rate provide the Bank of Canada with a rationale for the further interest rate cuts, meaning to stimulate economic growth while maintaining inflation.
So now we are discussing about the potential side effects of this thing. First of all is the interest rate adjustments. While lessing interest rates can lower the mortgage and borrowing costs for the consumers and the businesses, this can also lead to increased inflation in the future. As people borrow more and spend more, demand can outstrip supply.
Okay. Consumer spending. Lower inflation and reduced interest rates tend to boost consumer faith when people feel and more secure about their finance because they are paying less on loans or mortgages. They tend to spend more.
Next potential side effect of this thing is housing market dynamics. As the reduced interest rate may lower the borrowing cost, so more people will tend to buy the houses, and that can eventually reduce the price for these things. So that is the main drawback of it.
Let's talk about this key stakeholder. First of all, it's the consumers. People will benefit from low borrowing costs, allowing them to make purchases and invest easily. What about you? What do you think?
Talk about business. Lower rates might boost consumer spending and spending helping business grow, however, and businesses may face unstable demand and pricing pressure as inflation and borrowing costs shift.
I think the Bank of Canada is also a key stakeholder because the bank is responsible for balancing interest rates and policy to manage inflation and restoring economic growth.
So now I will speak about the beneficiaries of these things. First of all is the home buyers. The low cost and the low rates allow more people to buy homes, making the housing ownership more approachable. The next beneficiaries are the businesses. The companies can see a growth due to the higher consumer spendings and the investments made.
Negatively affected savers. People who depend on savings may smaller return as interest rates fall. With lower savings rates, their wealth grows more slowly.
So now we'll talk about the article perspective. The article takes a realistic approach, telling about and doing the analysis of the economic conditions without telling about the stance of the Bank of Canada. Now we will be discussing about the opposing views. First is the pro-interest rate cuts perspective. Those who is in the favor of this view argue that the interest rate cuts is the best way to restore the economic growth, especially the labor market which is facing the weakness.
And then furthermore, by lowering rates, the Bank of Canada and can support business and consumer creating the conditions of faster economic recoveries.
cautious perspective, experts warn that cutting rates too short could lead to future inflation.
The worry that what lowering rate now could break long-term as rise inflation in the future may require even more rated measures which could hurt the economy.
The first main defense is support for economic growth. The Bank of Canada is continually cutting the interest rate to foster the economic growth by making the borrowing more affordable.
The next for the challenge, according our research, one of the major interests with lowering interest rate too much is the risk of inflation risk rising again.
Recent data validation supports the first defense point. The drop in inflation supports the Bank of Canada's and decision to reduce interest rates. This recent data shows that the strategy is working. The decline in inflation back up the idea that rate cut were necessary.
However, economic overreliance is another issue that if we depend on low interest rates for too long, it can lead to people borrowing money from businesses, and when people borrow so much money for businesses, they can't handle it anymore.
The last one for the conclusion, the article shows an important moment in Canadian monetary policy where the Bank of Canada's choices will be greatly affected by labor market conditions and inflation trends. The demands for growth and economic concerns must be properly balanced by policy makers, which call for ongoing assessment and change as the economy improves. Thank you.